Can you
from
speak
the
real quick to before we just wrap up with Q4 earnings? Someone was commenting that 75 as a multiple is absolutely insane, or even like 65. Can you speak to a little bit of like, are you being insane assuming that, or is that reasonable?
Yeah. So that's a good question. So basically, like what we looked at was the big tech comps,
Yeah.
like what we were like the big tech comps being like Amazon, Apple, like Microsoft, Google, Facebook. Now, I mean, I guess they're still big tech. Netflix is beside the point, but like Nvidia, like big tech, looking at that and like seeing where they typically trade, like they trade at like almost like a 2 times peg. So then you have to believe that the Palantir story is not finished in 2030. Like the Palantir story has room to go versus like these big tech companies, like they're starting to come into a mature phase.
Right.
So then you have to say, okay, well, if you're going to trade it like 60 to 75 times, then effectively, if you're saying that, like, let's say in a very conservative case, right? Palantir grows its revenues in excess of 30%, 35%, whatever, in the like the first part of this decade. I mean, obviously 20 to 22 is over, but like through 25, like if they grow over 30%, like 35% through 25, and then in the back half of the year, they grow like 25% each year, that's going to net to 30, right? But like your multiple is going to be based like on a forward expected growth rate. So you can say like the growth is eventually going to taper off. Like you're going to go from 35, like somewhere down the line, it's going to start to inflect into the 20s in the later half of this decade. That's a very conservative assumption, because you can then say the other way around and say, well, wait a second. If this business is hitting its prime time, and this is just start, like the guy that you like that's been holding Palantir for years before like that he was on CNBC, he was like saying like he believes that this company is like in its infancy. So then if that's the case, then growth doesn't slow down. It doesn't go into the 20s. It accelerates. It starts going to the 40s consistently, like going 40s, 50s, 60s. So I think it's very conservative to say their growth is going to start coming down in the back half of this decade. Like that might not happen. The exact opposite might take place. Like they might be getting like 60% revenue growth or 50% revenue growth in the back half of this decade. But let's say their growth in a conservative case comes down into like the 20s to 25s at the back half of this decade, and then the forward projection of growth is in the 20s. Then if you apply like a 2 or 2.5 times peg, like peg multiple, well, peg ratio on that, basically saying that your price to earnings relative to your growth, then you can get to it like at least a 50 times multiple, at least. So like you're saying like 20% growth forward as in the expectation. You take 2 or 2.5 times that, you're at 50 times, 2.5 times the 20, then you're at 50. And that's your like that's your peg assumption. Right. And then you can also say like you can look at other companies, like you can look like a Salesforce, you can look like a Apple or Microsoft, which trade at even higher peg, and like use those and say like maybe a 3 times peg is warranted. So 3 times 20% growth. So that's like 60 times. Like these are what these companies are being traded for today. Now then you have to ask yourself, well, do you think the multiples that those companies get are warranted? Because that's another question, because you're basing it off of like a relative comparison to what other big tech companies trade for. If those multiples aren't warranted, then yeah, okay, then it makes sense that your multiple is ridiculously high. But if you feel like the market overall judges Amazon, Microsoft, like the big tech relatively fairly, I dare say undervalued. Like you look at Google, look at, I mean, there's many companies you could argue like one way or the other, but if you feel like they're relatively undervalued or even like fairly priced, then you can say like those are the multiples that we should just then apply to Palantir, assuming similar growth rates, and like a return on invested capital and things like that. But like I think the growth assumption that growth is going to start to decline, like percentage-wise, in the back half of this decade, is actually a very conservative one. Because if you're saying that this is a business that is in its infancy and is going to start to hit prime time, really when, like, I think there's a chance that most companies don't even realize that they need Palantir. Like even Karp was saying on the call, like first they were adversarial against IT. Now they're just trying to convince companies that like, there was value capture that they missed before. They're not going to miss capturing that again. So it's making sure the companies realize, okay, like Palantir solution is what we need. And they just don't realize like that it's available for them to just, this exists,
Can you explain what he said when he was like there was value capture that we missed? Because I was a little bit confused on that as well. What did he mean by like 7 years ago we didn't fully capture the value we should have? with IT departments?
I think like this is just my best thought experiment onto what he was saying. Like I don't, I could definitely be wrong here, but I think what he was saying was that before they had a methodology where they treated like salespeople, they had a very like bad taste of salespeople.
Yeah.
So because of that, they said, okay, our tech's just going to win out, right? But there was other less maybe like not as good players in the market or like services that were being offered to these companies that they saw like these consumers were like the companies were buying these services.
Mm-hmm.
So they were thinking maybe he was thinking to himself like, well, why didn't we get that money? We should have totally capitalized on that. We just missed it. We were treating it, we were selling it the wrong way. We had the product, we had it better. We just wouldn't do a good job convincing the people that mattered that they should be using our product instead of like whatever else they went with, whether it was an internal or external solution. I think that's what he meant by we lost value. Like we didn't capture value. We're not going to make that same mistake again. Exactly. And I think that's why they're hiring some more salespeople. But like, I think the model is very conservative. It's saying that your growth is going to decline, growth percentage is going to decline in the latter half of this decade. It could very well go the other way and accelerate. And then maybe, if the growth is like at 10 to 15% in the back half of this decade, then yeah, a 50 to 75 times multiple there's no reason that can be warranted. Like this doesn't make any sense. Right. But if you still believe in the back half of this decade that they'll be in a 20% growth range at least, then at least a 50 times multiple can make sense. And that's what 50 times. What do we say? Like 1.5 in EPS.
Yeah.
Pulling that up on a calculator, like 1.5 times 50 times, $75. Trades at what? Let's call it 10 today. I mean, it's technically at 11, but let's call it for simple math 10. It's 7.5x. Right there.
Right.
So anyway, I mean, like you can apply whatever multiple you want, but like that's how I come up with that. Relate it to big tech and see what big tech trades for, and then apply the similar multiple, assuming a similar growth rate that big tech has today.